Welcome to the fascinating world of Forex, where currencies are the stars of the show. Forex, short for foreign exchange, is a decentralized global market where all the world's currencies trade. It's a stage where currencies strut their stuff, dancing to the rhythm of global economic fluctuations. But unlike a typical market, there's no central marketplace for foreign exchange. Instead, currency trading is conducted electronically over the counter, meaning all transactions happen via computer networks between traders around the world, rather than on one centralized exchange. Now let's talk about currency pairs. In the Forex market, you're not simply buying or selling a single currency. Instead, you're buying one currency while simultaneously selling another, hence the term currency pair. This interesting mechanism forms the basis of all Forex transactions. You see, in the world of Forex, no currency is an island. Each one is intrinsically linked to another, and it's this relationship that forms the heartbeat of Forex trading. Imagine you're at a currency exchange counter at an airport. You're just about to go on vacation and you hand over your dollars to receive euros in return. In essence, you've just traded a currency pair. You've sold dollars to buy euros. This simple transaction is the fundamental operation that underpins the colossal Forex market. The Forex market is a thrilling, fast-paced world, a place where fortunes can be made and lost in the blink of an eye. It's a place where traders from across the globe come to speculate on the movements of currency pairs, hoping to profit from changes in the exchange rate. But remember, while the potential for profit is large, so too is the potential for loss. That's why understanding the mechanisms of Forex trading, including the crucial concept of currency pairs, is so important for anyone considering entering this market. Now that you have a basic understanding of Forex trading, let's delve deeper into how currencies are traded in pairs. In the Forex market, currencies always come in pairs. This principle is as fundamental to Forex trading as the law of gravity is to physics. When you're trading in this market, you're essentially betting one currency against another, hoping that the value of one will rise or fall compared to the other. Now, these pairs are typically classified into three categories: majors, minors or crosses, and exotics. Each of these categories is defined by their liquidity and presence in the market. Let's start with the majors. These are the most traded currency pairs in the world, and each one features the US dollar on one side. Examples include the euro against the US dollar against the Japanese yen, and the British pound against the US dollar. The big draw of the majors is their high liquidity, meaning they can be bought and sold in large volumes without significantly affecting their price. Next, we have the minors or crosses. These pairs don't feature the US dollar. Instead, they're made up of the major currencies against each other. Think euro against the British pound or the Australian dollar against the Japanese yen. While they're not as liquid as the majors, they still offer plenty of trading opportunities. Lastly, we have the exotics. These are pairs that combine a major currency with one from an emerging or smaller economy, such as the US dollar against the Singapore dollar or the euro against the Turkish lira. Exotics aren't as liquid as the majors or minors, but they can provide exciting opportunities for traders willing to navigate their higher volatility. So, there you have it. From the highly liquid majors to the more exotic pairs, each brings unique opportunities and challenges. Let's explore these categories further. Major currency pairs are the rock stars of the Forex world. A bold statement, but not without merit. These pairs, often referred to as the majors, are the most frequently traded and involve the US dollar paired with one of the 7 other most liquid currencies. These include the euro, British pound, Japanese yen, Swiss franc, Australian dollar, Canadian dollar, and the New Zealand dollar. The US dollar's prominence is no accident. As the world's primary reserve currency, it plays a vital role in global trade and finance. This means that a vast majority of international transactions involve the US dollar, creating high demand and consequently high liquidity. But what does this mean for you as a trader? Well, high liquidity essentially translates to stability. It means that these major pairs have tighter spreads, which reduces trading costs. It also means that there's enough market activity to enter or exit trades at any time. This kind of stability is a big draw for traders, especially those just starting their journey. Now let's take a closer look at these major pairs. The EUR-USD, GBP-USD, USD-JPY, and USD-CHF are considered the Big Four. They're the most widely traded and watched by traders, institutions, and even governments. The AUD-USD, USD-CAD, and NZD-USD, while not as popular, still hold significant weight in the Forex market. Each of these pairs has its unique characteristics and is influenced by different factors. For example, the GBP-USD is often affected by economic announcements from both the UK and the US. On the other hand, the USD-JPY could be influenced by changes in interest rates or the overall risk sentiment in the market. Understanding these dynamics can give you an edge in your trading strategy. But remember, while the majors are the most traded, they're not the only game in town. There are plenty of other currency pairs to explore, each with their unique opportunities and challenges. While majors dominate the Forex scene, there's more to the story. Let's uncover the other players in the currency pair game. Crosses and exotics may not be the first choice for all, but they certainly add spice to the Forex market. Now, imagine a world beyond the US dollar. Yes, it exists in the realm of Forex trading, and it's a thrilling one. These are the cross-currency pairs, often known as crosses. They are currency pairs that do not involve the US dollar. For instance, the euro against the Japanese yen, or the British pound against the Swiss franc. While they may not enjoy the same liquidity and stability as the majors, they offer a change of pace and can be a goldmine for those who understand their dynamics. Moving further into the less charted territories of Forex trading, we stumble upon the exotic pairs. These are, in essence, a major currency paired with a currency from an emerging economy. Think along the lines of the US dollar against the South African rand or the euro against the Turkish lira. These pairs are like the wild cards of Forex trading. They are characterized by their high volatility due to the economic instability of the emerging economies involved. But with high volatility comes the potential for high returns. Exotics can bring about substantial profits, but let's not forget, they carry substantial risks too. The key to navigating these choppy waters is understanding the economic conditions of the exotic currency's respective country. Political unrest, economic policy changes, and even natural disasters can all significantly impact these pairs. So, why delve into crosses and exotics? Simply put, they add depth and diversity to your trading portfolio. They allow traders to speculate on different markets and offer opportunities for hedging against major pairs. But it's essential to remember that they require a higher degree of understanding and risk management. Crosses and exotics offer a world of possibilities. But remember, the Forex universe is vast with a plethora of currencies. So whether you're a seasoned trader looking to diversify or a curious newcomer seeking excitement, crosses and exotics can provide a unique trading experience. Just be sure to navigate these waters with caution and wisdom. The Forex market is a global stage where currencies from around the world come to perform. It's a vibrant and diverse arena where each currency carries a unique story, flavored by its respective country's economic situation. Let's take a moment to appreciate this rich tapestry of global currencies. From the US dollar, the world's primary reserve currency, to the euro, yen, and pound, representing some of the largest economies. Then there's the Canadian and Australian dollars, often influenced by commodity prices due to their resource-rich economies. We also have currencies from emerging economies like the Brazilian real, the Indian rupee, and the South African rand, each with its distinct dynamics. But that's just the tip of the iceberg. In the Forex market, there's a whole spectrum of currencies from the Swiss franc, known for its stability, to the Mexican peso, a symbol of emerging Latin American economies. Each currency is like a character in a play with roles shaped by their country's economic indicators, geopolitical events, and market sentiment. Consider the economic indicators, things like GDP, unemployment rate, inflation, and interest rates. These are like the scripts that guide a currency's performance. For instance, a rise in a country's interest rates often strengthens its currency as it draws foreign capital looking for higher returns. Then there are geopolitical events. Elections, policy changes, conflicts, or even natural disasters. These are the plot twists that can cause sudden fluctuations in a currency's value. Remember Brexit? The pound took quite a tumble on that stage, didn't it? Finally, market sentiment, the mood of the investors, plays a crucial part. It's the applause or boos from the audience, driving the currency up or down. So you see, each currency in the Forex market is like an actor, performing on the global stage under the influence of its economic script, geopolitical plot twists, and the mood of the audience. Beyond these individual currencies, there are also intriguing groupings that add another layer to Forex trading. Stay tuned to discover more about these fascinating groupings in our next scene. Forex is a dynamic market that goes beyond the major categories. Now let's dive into the vast ocean of Forex and explore some additional categories of currency pairs. These categories may not be as well known as the majors, minors, and exotics, but they are equally significant in the grand scheme of Forex trading. One such grouping is the G10 currencies. This group includes 10 of the world's most heavily traded currencies from countries with highly developed economies. These include the United States, Canada, Japan, the countries of the Eurozone, the United Kingdom, Australia, New Zealand, Switzerland, and Sweden. Then we have the Scandies. This term is colloquially used to refer to the currencies of the Scandinavian countries, namely the Danish krone, the Swedish krona, and the Norwegian krone. These currencies are often traded against the euro or the US dollar, and their value can be influenced by factors such as commodity prices and economic indicators from their respective countries. Next up is the CEE, or Central and Eastern Europe category. It includes currencies like the Polish zloty, the Hungarian forint, and the Czech koruna. These currencies, while not as liquid as the majors, offer opportunities for traders who understand the unique economic conditions in these regions. Finally, there are the BRICS. This acronym represents the currencies of Brazil, Russia, India, Indonesia, China, and South Africa. These emerging economies have currencies that can offer high potential returns, but they also come with increased risk due to factors like political instability and economic uncertainty. Understanding these additional groupings of currency pairs can provide a more nuanced view of the Forex market. They represent various economic regions and levels of market development, adding layers of complexity to your trading strategy. With this knowledge, you're well on your way to navigating the diverse and complex world of Forex trading. And that concludes our journey through currency pairs in Forex trading. We've navigated the complex currents of the Forex market, delving into the mechanics of currency pairs, their classifications, and the diverse global currencies in play. From the liquidity and stability of major pairs to the unique dynamics of crosses and exotics, we've highlighted the intricate tapestry that makes up this vast, decentralized market. We've also explored beyond the major categories, touching upon the G10 Scandies, CE, and BRICS, each representing distinct economic regions and varying levels of market development. To cement your understanding, we recommend to complete Lesson 3. We invite you to continue your Forex education with Lesson 4, the magnitude and liquidity of the Forex market. Until then, happy trading.